In just weeks, the Federal Reserve could make a decision that shakes every market on Earth. The Federal Reserve controls the cost of borrowing money, and when they speak, markets listen. When inflation rises, the Fed raises interest rates. It makes borrowing harder, but cools the economy down.
The Federal Reserve sets interest rates to guide inflation and support employment bars down. It's one of the most influential tools in our economy.
The September Fed meeting is one of the most watched of the year.
It often signals where the economy is heading next.
Over the past 2 years, rates have moved up steadily, a response to changing economic conditions and inflation trends. Higher interest rates make mortgages, car loans, and credit cards more expensive, and that slows the entire economy. When the Fed raises rates, mortgage rates usually rise. That pushes buyers out, and home prices often drop. Stocks tend to fall when rates rise. Growth companies, especially tech, feel the pressure first.
Crypto markets are highly sensitive to interest rates. When money tightens, risk assets suffer fast.
Inflation has cooled from its 9% peak, but it's still above the Fed's 2% target.
The Fed aims to support a healthy job market and stable prices. That balance is central to every decision it makes. The U.S. job market remains strong, and that gives the Fed room to keep rates high if needed.
Some economists believe the Fed will hold rates steady, but others warn one more hike may still come.
Markets currently expect the Fed to pause in September gloomy, but even a small surprise could trigger volatility. Recent statements from the Fed emphasize flexibility per purse. Their next steps will depend on how key data evolves. If the Fed raises rates again, expect tighter lending, higher loan costs, and potential market pullback. If the Fed pauses, markets may breathe, but investors know a pause doesn't mean cuts are coming soon.
Smart investors are watching inflation, jobs data, and consumer spending, all before the Fed's next move.
In uncertain times, don't panic. Avoid emotional trades, and don't bet everything on a single Fed meeting. In the long run, markets adjust. Rate hikes come and go come, but long-term discipline always wins. While retail investors panic, smart money is rebalancing. They plan, not react.
Focus on what you can control. Manage debt, build savings, and invest consistently no matter the noise.
The Fed's next move could shift everything. Stay sharp, stay informed, and stay ahead.